Hey there, Evan here with Crypto and Markets for Monday, April 16th, 2017. Just want to go over a few quick headlines here this evening. This one here actually appeared out of Australia, believe it or not, this morning. And this is actually referencing the Australian housing bubble. I'll be honest, not something I've really covered at all, if anything, here on this channel. When I saw this article here, I really thought it was missing something. Here's the headline. RBA, that's Reserve Bank of Australia, flags dangers of $480 billion in interest-only loan resets over the next 4 years. Almost $500 billion in interest-only mortgages will convert to principal and interest loans over the next 4 years, jacking up monthly repayments for almost 1.5 million borrowers by as much as 40% and creating a fresh threat to house prices. Even if 10% of those borrowers have problems, with a bubble at almost $500 billion, that's still a $50 billion problem Australia has. That's a lot of money. And remember, some of the massive price increases we've had, especially over the last couple of years, Sydney and Melbourne especially, they're really just more or less your Toronto and Vancouver of Australia. I mean, when I see it. The reset risk comes as a direct consequence of a boom in lending that peaked in 2014, led by property investors who sought to supercharge their borrowing power by taking out loans in which the principal typically isn't paid for the first 5 years. Now guys, if you remember the subprime crisis in 2000 that led to what happened in 2006, 2007, 2008 in the US, a lot of these loans were designed the same way. A lot of these loans, were designed as interest-only loans throughout this time. As I'm reading this, I'm almost like, what was I missing all these years? But please, guys, leave a comment down below. Am I out to lunch here? Am I reading too much into this, or is this really happening? Please, let me know down below. And here's the one that really caught my eye. Remember the household debt to income ratio I talked about in Canada in a video I did about 3 weeks ago? To put it in context, right now we're at about 180%. The US, when they peaked, was at around 140-ish. But look where Australia is. Australia is pretty much almost at 200%. Canada right now is at 180. This is worse than Canada. Now, if you want to call me a conspiracy theorist, here's another little goodie for you. Remember this? The LIBOR OIS spread I talked about? Which is a good indicator of financial stress in the US during the subprime crisis? No, I told you it widened over 50 basis points for the first time since that point, about 2 weeks ago? Well, guess what? It spilled over into Australia as well. With where things stand and how elevated the Australian housing market still is. Now, I know it's been down in the last couple of months, but even still, look at how far you've come. We're just getting started here, in my opinion. But please, if you're more informed on this, please leave a comment down below and let me know. Am I out to lunch here, or is this really happening? Anyhow, a few more charts here. This is one of my favorite ones recently. The S&P 500 leading into 2018 versus the Nikkei leading into the 1990 crash. Again here, late 2016 S&P equals late 1988 Nikkei. Pretty much a straight correlation all the way up. We're right here now. And the way this chart's going, it's pretending about a 15 and 20% correction in about the next month. This chart has been very reliable for us. And to put it lightly, people have gotten very complacent again. And this next move, I think, is going to blindside a lot of people. And lastly, it was all over Twitter this morning. Oh, gas prices are going up. Gas prices are going up. I'm here to tell you, nothing to worry about. It's a late cycle thing. It'll come right back down probably in the next 6 months. This is a chart. The blue line is WTI crude. The red line is the S&P. Here's the S&P index chart. Here's the dollars. Here's the crude oil dollars per barrel as part of that chart. This is really 2008. As you can see, it bounced around as the S&P was breaking down, more or less like it already has now. And then guess what? We had the concerns about the Iran nuclear program, more geopolitics. I showed you the article from CNBC over the weekend, how all the analysts are basically becoming more mongers. Again, more geopolitics. A lot of the same things. Also, this time around, we have the apparent worry of Iran pulling out of the U.S. pulling out of the Iran nuclear deal. Again, they share an oil field with Iraq. They have a perfect way around it. Spice is going to flow. And then once the stock market going down, the geopolitics push the oil price way up. I don't see it happening this time, strictly for the reason non-OPEC producers have taken a lot of market share from the OPEC producers. To put it in context, U.S. was at 5.5 million barrels in 2008. Now they're at 10.5. Canada, I believe, was around 2.75 during that time. They're at 4.25 now, amongst other countries as well. What'll happen? It was a good chart, actually, in the article from the weekend. I'll go ahead and pull it out here quick. This is the Brent crude chart on a 1-year basis. Again, this is Brent, not WTI. Brent selling at about a $5 premium to the one in Texas WTI. Nice uptrend since late June. We're at about 72 right now. If it breaks the uptrend around 68, that's when the real downturn is going to happen. I'm not saying it's going to go down by a quarter, but we're going down by probably about half at the very least. Anyways, guys, I'll go ahead and leave it here. And please, like I said, someone let me know on the Australian housing bubble. Is it really as bad as I think it is? Let me know. Leave a comment down below. Hit the like button. Subscribe. Follow me on Twitter @CryptoMarkets2. Handles down below. Y'all take care. Have a good day.